should you take advantage of tax-free bonds? Let's talk about that for a bit here. Timothy Pynchon joins us from Pioneer Group in Boston. Are you buying bonds today? Are there opportunities out there?
Absolutely. I've been a regular buyer right through this meltdown that we've experienced over the last 6 months.
Is the meltdown over?
In my opinion, it's largely over. What we're dealing with now, more than anything, is the investor psychology that is really sort of a hangover from the really bad days in December, January, and February. But from the standpoint of fundamentals, we're looking very, very strong right now.
You're looking very strong. Has the free lunch been made? If you have a crisis for whatever reason in December, you get that total return pop of appreciation of price plus the yield. Is that easy part over, or does it have legs?
Well, I think the very easy part is over. When our Muni to Treasury ratio jumped to 112%, and there was a lot of so-called low-hanging fruit to be picked, we saw a very strong crossover trade coming in from the taxable funds. We saw a strong crossover trade coming in from the hedge funds. And so that was easy pickings at that point in time. But the fact is that our Muni to Treasury ratio today is right around 100%. We've seen positive flows now into the funds for the first time in nearly 30 weeks. And what we're left with is still value from all of that displacement that we experienced from Meredith Whitney's comments and beyond. And we really didn't see the tide start to change until the beginning part of May or so. And since then, we've seen uptick after uptick.
Right.
And I think that we continue to see legs, and I think that we're going to continue to see legs through the year end and into 2012.
Amazing how much mail I get on this. Let's look at that yield to treasuries. This is the benchmark here, dreaded first chart. Taking advantage of tax-free bonds. Shout out to Jay for that phrase, Muni bond guy. Okay, this is the ratio of a Muni yield to treasuries. Tim, how should our viewers use this yield? Is there a band where you buy bonds or sell bonds around that ratio of yield to treasuries?
Well, we use the Muni to Treasury ratio as an indicator of whether our market is rich or cheap. The historic average being somewhere around 85% on the 30-year Muni and 30-year Treasury. That's a good historic norm. So when we jump up to 100% or so, that starts to indicate that our market is pretty cheap. When we went well beyond that, it indicated that we were very cheap. So it's not that you can go and buy any bond. I mean, we're back to the mantra of understanding what one owns, understanding what one wants to invest in, and there are a lot of nuances to that. But as a general rule, I think that what we're being presented with at this point in time is a nice entry point into the Muni market.
Okay, here's the yield. This is just AAA 10-year Bloomberg fair value. One of the great secrets on the Bloomberg, great charts on bonds, on Munis. Here's the yield over 20 years. Down we go. Other people in fixed income, Tim Pynchon, are saying lighten up on the bonds, look at the equities. Can you make the same statement about municipal bonds, or are they so unique and so discrete that you remove them from the sovereign or the high yield space?
Well, I think there's a very strong case to remove them from that space. And the fact is that, particularly with the dislocation that we have experienced, number one, that created value. Number two is that we're in a very benign interest rate environment that we see extending well into 2012. And so for the high-grade municipals that are more interest rate sensitive, that gives us a long lead time before we have to start worrying about inflationary pressures or the Fed starting to tighten. And so if that's the case, then I think it makes the case for being a very nice, again, a very nice entry point into the market. And then, Tom, I will add, too, that, you know, one thing that's been overlooked, I think, in the analysis given by Meredith Whitney and the follow-through on that is that When we talk about the general obligation debt, that's one sector of our muni market.
That's exactly where I wanted to go. Let's go to a break here, Tim. This is important, folks. We're going to come back and talk about this continued debate. As you know, I've interviewed Meredith Whitney a number of times after the 60 Minutes interview. We're going to focus on that next. Here's a note from Tim Pynchon. Look at this. You didn't know this. I didn't either. Default rates within the high-yield municipal market, they remain remarkably low versus high-yield tax-frees. That's the land of Margie Patel. And the fund's default rate continued to hover at around 1%. Here is Meredith Whitney on Bloomberg Radio on surveillance. I asked her about the debt burden facing the nation's states.
States have avoided making tough decisions for years, so they've been overspending their tax receipts over 2.5 times their tax receipts that it goes out versus coming in. And they've been doing so by underfunding their pensions. And the debt burden has been accumulating. The off-balance sheet debt burden is 75% of states' total liabilities. And that is just, in the case of New Jersey, they're paying over 16% of their budget just on paying fixed costs.
And there's Meredith. Here's Fortune magazine in the last number of days. I continue to believe the degree of defaults will be borne out over the cycle. I meant to point out that the state debt problem is a headwind for the U.S. economy, second to housing. Timothy Pynchon with us pushing back on this. Do you link housing into state and local budgets? That seems to be the distinction here in this debate. Do you keep housing exogenous, or is it endogenous to municipal finance?
Well, Tom, I don't think that you can eliminate housing from the formula, and nor do we want to do that. But what we're seeing as a work in progress is that states, these difficult stories that are in the press now with Minnesota and Wisconsin and California and New Jersey, to us, what that represents is that it's a work in progress of implementing very painful but very necessary steps. And they're doing that. And so what I think that does is give tremendous pushback against the idea that there's going to be a wave of defaults or a rash of defaults as we move forward. And what I take strong objection to is the idea that the story coming from Meredith Whitney seems to change almost on a weekly basis. First it's defaults, then it's the downgrades, then it's the idea that somehow refinancings represent defaults, and we take strong exception to that notion. Refinancing is an integral part of any borrower's purview of tools in their toolbox to get their budgets in balance. And so,
go ahead, continue, please.
Well, I was just going to say that what we think is really happening now is that these, the fact that a state is stressed or a municipality is stressed does not equate to a default or bankruptcy. Bankruptcy is generally the measure of last resort. Right. And we've seen, for instance, with Vallejo, California, that that's not really the measure that these municipalities want to undertake. It's time-consuming, it's costly, it's ruinous to the creditworthiness of that given municipality. And so the cuts that we're seeing, for instance, whether it's furloughing workers, whether it's cutting back on library hours or recycling center hours, those are all steps that I think are going towards the good of balancing budgets. How
have municipal prices reacted in recent weeks? If you look at GO and you look at dedicated revenue bonds versus the garbage out there, my suggestion from you, David Kotok, Dan Clifton, our own Joe Mysak, is you've got to make a distinction between the paper, don't you?
All day long. And this is what, there's a notion out there that I think Meredith Whitney has ridden in on a white horse and is somehow saving the municipal market. The idea that municipalities were under stress, that's not new news. It wasn't new news in December on 60 Minutes. Maybe for the folks on 60 Minutes, but not for the professionals in the muni market. This is why my partner David Yurkis and my counterparts at other firms have been avoiding general obligation debt and going into project revenue debt. And that's the hospitals,
Is some of this
Hospitals,
tension? Well, Tim, that's fine. Is some of this tension? And I know David Yerkes from, I think, it was after Lincoln. I think it was more like Rutherford Hayes or one of those. David Yerkes has been doing this for something between 2 and 4 million years. Are you guys upset that Meredith's really not a full-time Muni pro? I mean, let's come on. This is like Dr. Phil or some gossip hour. Are you guys upset that your grizzled Muni pros, where Meredith really made her name off Citigroup?
Well, let me put it this way. I think that if you, Tom, have a backache, that you don't go to your podiatrist to solve that backache. And I think that there's a sense that when you hear the analysis given, that there's not a deep understanding of the municipal market and that there are flaws within that analysis, such as a refinancing equating to a default. That simply is erroneous. The idea that stress leads directly to bankruptcy is erroneous. And so it's the idea that we understand that there's stress, but that there's this whole other segment that that provides very good value and opportunity for investors. And it was the fact that on that 60 Minutes analysis that our market was painted with this very, very broad brush without distinction given towards the idea that there are pockets of risk. Yes, everyone acknowledges that, but that generally speaking, even general obligation debt is sound,
Okay.
and that project revenue debt is a whole other animal unto itself, and that given proper analysis, as we've been doing for years and years and years, that there's value there for investors across the board.
Very good. Timothy Pynchon, thank you so much for coming to us with Pioneer Group.